So with that, I introduce Brad Connors.
All right. Thank you, Sean. Appreciate it. Thanks for everybody being here, too. I'm excited to go through some information with you today. You know, most of us from Waseca, we know Charlie's Hardware, which isn't there any longer. Obviously, Charlie's retired with the Fish Don't Clap book, apparently. But if Charlie he and I used to joke about him making the biggest bang for his buck in bad times. So all of a sudden the basement floods and he's selling sump pumps, and we get a blizzard and he's selling stuff to move snow. And I think our room's a little bigger and we have more people signed up today because of that, with what's going on in the market at this point. So I appreciate you guys all taking time to be here. You guys obviously had a chance to meet Sean. We've got some other people on the team, but we've got a great team at iWealth. There's actually 10 of us now that are on the team. And so Sean and JP's over a year with us. They're both financial advisors and meeting with people. You might not know that we opened an office in Bloomington last year. And so we have an office, actually about 18 months ago. So we have an office up there and we have one in Waseca as we continue to grow. So they're both here today, and Deb, you might have met on the way in. She's been here. She just hit 5 years with iWealth on a team. He does a great job. And our newest member is Matt Potter. And Matt, we hired to be our COO, and he's been here for a month and a half. So if you need anything, ask him. He'll make sure he takes care of it for you. So. But really appreciate you being here. You know, most of you guys know Trudy, my wife. We just celebrated 25 years, and I always tell people I over-married. And I believe that with my team, too. If you surround yourself with good, smart people, you're going to look better, too. And so we've got a really great team at iWealth. So, but I appreciate you being here. And just a couple of housekeeping things. As Sean mentioned, LPL Financial, they're our broker-dealer. So we need to be hooked to somebody that oversees us, let's say, from compliance and oversight and those type of things. I think there are over 20,000 advisors now with LPL. They're the largest independent broker-dealer that's out there. We don't work for them. You know, we're partners with them, but they don't have any products or anything like that. So one of the things when we started iWealth years ago is to be truly independent, and we have that independence. It's really, really important to us. Also, we all have these, so if you have one, if you haven't checked, if you just make sure you put it on silent, I'd really, really appreciate it. Also, questions welcome. If you have a question, just raise your hand. Let me call on you and let's talk about it. If it's something that's coming up in the presentation in the future, I'll go ahead and tell you to pause and we'll talk about it when we get there. But if anything comes to your mind, just make sure that you bring that up. We've been doing this for over 10 years. And it's just important that we have a conversation together. So if something's on your mind, feel free to ask it today too. So let's talk about the agenda. How did stocks perform in 2021? What drove that performance? We're going to look through a timeline of what happened last year. It's pretty amazing of all the stuff that kind of went on. Where are we now? And then what do our financial experts think is coming this year, especially in light of what's going on? But one of the things about us at iWealth is we're never going to stand up and pretend like we have the answers to everything. We don't sit in a room at iWealth and try to figure out what's going to happen to monetary policy and fiscal policy and inflation and in the Fed. We have some really large firms that we work with that helps provide that data. And then our job is to have an opinion, to put an opinion together, and you're going to get that opinion today. But it's not just us here, it's the people that we count on and we have a history with, that we gather that information with. So the elephant in the room is this Ukraine thing. You guys just probably saw an email that came out to us. I believe we sent it Friday. And I just have to put this up. When we opened up iWealth, this went up on the wall. It's still there today. And Sir John Templeton was a famous investor, and the four most dangerous words in investing are, it's different this time. Think back to when we hit Dow 10,000 and how everyone's like, well, we've hit the precipice, now it's going to go down. Or 9/11, or Afghanistan, or the financial crush we had in 08 and 09, and how the statement is, it's different this time. It's pretty easy. A lot of times people in our industry will get put off from the standpoint of just saying, just buy low and sell high and time in the market and things like that. But guys, I'm going to show you some slides in a little bit. It truly is part of the equation is it's not different this time. When you watch the news, it can get that way. And so I sent a video out, one of my quarterly updates not too long ago, and some of you, if you've been in the office, I maybe have shared this with you. But around July, I told you Trudy and I have been married 25 years. We're high school sweethearts, so we've been together longer than that. Around July 1st, I sat down with her in our screened-in porch. I'm having a cup of coffee. And I said, I don't know what's going on, but I can't get happy. Like, I can't smile. My daughter was in Spain studying abroad and living her best life. There's a new boat on the boat lift. Great people at iWealth. We're healthy, but I couldn't smile. And a couple things happened because of that conversation. First of all, after she thought about it, she said, Brad, maybe you need to turn off the news. And she wasn't wrong. She was right. I've told clients to turn off the news. I tend to be a little bit of a news junkie, and it just wasn't working for me. By the way, Michelle has been with me in my office as long, and as I shared this story with her, she brought up the news thing as well. So I had two people tell me to turn it off. And what's interesting about doing that is now, I'm over 6 months into this thing, is that you still pick up on things. My routine now is about 10 minutes of Wall Street Journal in the morning, and about 10 minutes of CNBC when I'm getting ready in the morning, and that's it. No local news or anything, but you still will catch some stuff as you go. And I can smile today, so I can at least tell you guys that. And the second thing I did is worked on what we're calling the vivid vision. So 3 years from now, what does things need to look like from a business, professionally, and personally kind of standpoint. So I bring that up to you, not to have any pity on me. I'm in a better place today, but it was pretty foolish of myself to not be able to smile with all the great things going on around me, and it happened to be the noise that was going on in my head, and a lot of it had to do with the news. And if you're in that spot, or you know somebody in that spot, they might have to turn that off. Monday night, I'm driving up to the cities. I had early appointments on Tuesday, and Trudy called me, and she said, as we're talking, she's like, Brad, I'm so nervous about this Russia thing. And I'm like, well, what's going on? Why? And someone on Facebook had family in Germany, and they were concerned about their well-being, which is totally true. But I said, Trudy, how are you going to change that? I mean, we can pray for those people. It's horrible what's going on over there. But how is it going to change when you wake up tomorrow? And it doesn't change anything. And so I just bring this up to you, and we got some slides that we're going to go through, but it's not different this time. But let's take a look at some past things that have happened over the time period. So this is taking a look at history points of short-lived volatility and geopolitical events. So the first thing that's here, if you take a look at the oil embargo, 1973, 27 days it sold off. It took 1,400 days to get back. It took a long time to get to back where it was. And the size of itself was 17%. Take a look at these now, though. If you take a look at the Iran hostage crisis, the Libya bombing, first Gulf War, take a look at 9/11. It took 6 days to sell off. It took 15 days to get back. And we were down 11.6%. The average, guys, is 12 days to hit bottom, 137 days to recover, and that's taking into account back in 1973, that was $1,400 or 1,400 days. 6.5% is the average sell-off. So I just wanted to start out with this slide because we have received some calls, rightfully so, from some clients. We've sent some information. I want to be careful that we don't over-communicate and you guys think that we're panicking, because quite frankly, I think it's a good time to be buying, not be selling. But this is to help give you some context of where we're at. It's horrible what's going on in Ukraine. To those people, I can't imagine in today's day and age somebody coming over here and doing something on our soil, but it's horrible for them. We need to pray for them. But quite frankly, it's a blip on the screen when it comes to your investment portfolio. So how did stocks do in 2021? And then we'll talk about 2022. So again, these are some firms that we just take a look at what their thoughts were in 2021. It closed, the S&P, so S&P 500 large company United States stocks, closed at 4,766 at the end of the year, and it was up 26% last year. If you were 100% in the S&P 500, you're up 26%. By the way, most of our clients are not. You need to be diversified, but just take a look at the gauge. But Morgan Stanley thought it'd be 3,900, JP Morgan 4,500. Guys, the consensus was 4,117, and it finished at 4,700. These guys have some really smart men and women in the room to get to their equations, and they have to have a prediction at the end of the year. Our job isn't to look at one, but to get a consensus. By the way, that was all an increase over the year prior, but no one predicted that we would have the year like we had last year. So let's take a look at what drove this performance. So if we start down here in January, we had the inauguration of President Biden. We know the events that led up to that as well. And then we had the 1.9 trillion COVID relief bill that came in. We had a 100 millionth vaccine that was administered on March 19th. The S&P closed above 4,000. So remember where we finished and it closed above 4,000. The consensus was about 4,200. That was back in April 1st. We started to add some jobs. April 2nd, 916,000 jobs. April 29th, we had gross domestic product expands by 6.4%. So the economy started to take off. May 12th, now we had the inflation scares. Remember the whole transitory inflation? We'll talk about that in a little bit, which transitory was supposed to mean temporary. But inflation rose to 4.2. May 13th, the CDC says vaccinated people can go maskless. July 19th, the Delta cases surge. You can see the stock market chart above it. Then we had the Delta variant peaks, September 13th. We had a sell-off. And then November 3rd, the CDC approves a vaccine for 5 to 11-year-old. Fed announces tapering, so they were going to stop buying bonds. The Omicron variant started the 26th. Inflation started to surge. Q3 earnings surged. And the FOMC announcements, which we'll talk about in December. But what a year when you look at all the different events just in the last 12 months that took place with new presidency and COVID and everything else. And to sit back a year ago after we went through the shortest recession ever and to say we're going to be up 26%, nobody would have predicted it. It was certainly a heck of a year when it comes to stocks. So revenue growth, this is corporate earnings. And what I want to point to is at the very beginning of this slide, 2016, and you take a look at the growth at 5%, 7, 5, 6, that's where we were hanging for corporate growth. That means how healthy are they? Are they growing their companies? What's going on? So you go all the way up here, and then we get the shortest recession ever. So second quarter of 20, we're down 9%. Corporate earnings shrinks in Q3, and then it starts to grow. But look at these numbers, guys. 10%, 25%, 17%. Fourth quarter was north, I believe, of 20%. The corporate earnings are growing, and that's what's helping grow this stock market. Companies are making money. Most of the small businesses that I've dealt with over the past year, most of them have had their best year ever. And that includes farmers. And it might not be this year. I understand input costs are up and things like that, but last year, most small businesses did really, really well. Call that pent-up demand, call that taxpayers' money given back to them through PPP loans, whatever it is, they had their best year ever last year. And so this corporate earnings revenue growth is going to continue. It won't be in a 20% range, but that's supposed to continue this year, which should continue to drive stocks, which we'll get into. So where are we now? I love this because I'm simple and I can understand colors. So red is not good, yellow is yield, and green is good. Now, this is March of 09, so I just want to give you some perspective. This happens to be one of the money managers that we use called City National Rockdale, and they put this chart out, and they put it out for 15 plus years, I believe. And they put it out on a monthly basis. But if you look at March of 09, back when people would say our last recession was, which isn't true because it was right at the beginning of COVID, we had a very short recession. But take a look at these indicators from credit to U.S. economic outlook, to personal wages, to job creation. It just did not look good. That was March of 09. Now if we look at this chart, January of 2020, so right going into the last very short recession, you can see that there's some yellow on here. The only two, which political environment normally is always red, doesn't matter who's in charge, it just seems like that's always an issue. And geopolitical risk, stuff like what's going on right now with Ukraine and Russia, North Korea, those type of things. But we had some yellow indicators January of 2020. If we go to March of 2020, look what happened. A lot of those yellow turned red, and this was that last recession that we had. And you can see here from international to corporate profit growth, which we just looked at, business outlook, the labor market, consumer spending, a lot of negative things as the economy was being shut down due to COVID, March of 2020. Now we take a look at January 2021. You can see that it's starting to improve a little bit. There are some yellow, and we've got 2 red that's showing up, political and geopolitical risk again. But for the most part, getting healthy coming out of that recession that we had in 2020. That's January of 2021. Now let's take a look at what it looks like today. Yellow. Now I will tell you, their slide came out for February, and obviously this geopolitical risk is red. I wondered if it would go red with Russia, and it went red. So every month these get updated, but take a look at where we're at January of 2021 here. In January of 2022, take a look at what the S&P did last year. Look at what the economists were saying that they expected for the year. And this will tell you that we're on pretty good footing. And we're going to go through some of what that footing is. We're going to look at some headwinds, and we're going to look at some tailwinds. But when you just look at the color on this chart, the speedometers tell you that we're on pretty good footing. And like I said, there is one red now, which is geopolitical risk. So what are the headwinds? What are we facing that could potentially hurt us on a go-forward basis? So Omicron and Delta variants, and is there going to be another variant out there? What is that going to look like? Inflation and rising yields, the Fed policy pivot, the transitory, which now seems a little bit longer term. We're going to talk about this. Slowing China growth, like it or not, they buy a lot of our stuff. And when their economy slows down, it affects us as well. Midterm elections and geopolitical tensions, which this was done obviously prior to the invasion that happened. So what are some tailwinds? What are some things that are going to help push this economy along and have a decent year this year? Economic expansion continues, and that's what you're seeing with the charts that are out there. Continued monetary accommodation. We believe that the Fed is going to continue to look at this economy and continue to want to keep this economy going. We'll talk about interest rates in a minute. Corporate profits are going to continue to exceed. We're seeing that. We saw Target yesterday. We're continuing to see them beat their estimates. And a healthy consumer. We're going to look at your guys' balance sheet, and we'll show you what that looks like now too. So equity values, I use this every time we put this on just to give people context, because this term is thrown out on TV. It's called price to earnings ratio. It's called PE ratio. Chart's very busy, but when you take a look at the average PE ratio is 16.8. And the way I explain this is, let's say that I had a dry cleaning business uptown and it made $100,000 last year. And I was going to sell my dry cleaning business. What would you be willing to pay for it? Would you pay 10 times earnings? So you'd give me $1 million? Would you pay 5 times earnings? What would you be willing to pay for that cash flow of that $100,000 a year? And the market says that the average is 16 times earnings. When you take a look at where things went, we were up here on October 31st at 21 times earnings. You can see one standard deviation, which is one notch up, is basically at 20. And what's this saying is that stocks were getting fairly expensive. Now, with what's happened in the last month, they're now more on sale because of what's happened with the market being down. But you can see that history speaking, stocks are a little bit more expensive, but yet the economists feel that there's enough tailwinds out there with cash and corporations and with people that it's going to continue to evolve and push things forward. But this is the price to earnings ratio, and just taking a look at kind of where stocks are valued at this point. So 2022, what's it look like? So yesterday, guys, we hit 4,306 on the, when you take a look at the forecast for the S&P. So 4,306, you take a look at these numbers, 44, 48, 52, 46, 5, 5, and the average is 4,867. So from today on forth, this was before Russia, which I don't think, from my understanding, these guys haven't revised this target. From today up, that's about a 10% growth from here up to the end of the year if we hit the average. Last year they blew away the average. But when you look at where the S&P is at today and where they think it's going, it's higher than it is today when you look at the average of all these different companies that we're following. Assets, liabilities, and net worth. This is you guys. This is all of us in this room. This is what's gone on over time. This is going back to 2007 up to 2020. And the red bar here is liabilities. That's all of our debt. And the green is our assets. It's what we own. That's everything we own. And you subtract the liabilities from the assets and you get your net worth. And you take a look in trillions of dollars where we were at in 2007, call it 60, and where we're at now and call it 140 since 2007. People have assets, they have equity, they have money in their bank accounts to be able to continue to buy stocks when they're on sale and continue to invest and things like that. People are pretty healthy, but they also can go to Walmart and buy the next TV for the Super Bowl and all those other type of things that we tend to celebrate. Boats. I got an email the other day from a company down in Iowa that they're short supply on boats again. We know about the cars, all that other kind of stuff. But people have money to be able to continue to expend and keep this economy going. Quarterly periods of earnings and growth. This is taking a look at corporations now, the S&P 500. And it's showing here the earnings revenue growth Q3 of 2021. You can see the earnings, almost 40%, and a revenue of about 17. Those numbers are a lot higher than what the average is. And so corporations are very healthy as well. And so when corporations have money and they can spend and reinvest back into their own businesses or buy other companies, when you and I have more money that we can continue to live our life, and we'll get into some unemployment stuff here in a minute, that means that this economy should continue to hum along like it has been. Inflation. So we talked about the transitory inflation. In our office, we have meetings monthly with some of our financial professionals that help manage some money. And we've had some pretty interesting conversations with them as one of our financial partners tried to use the transitory term around October. And we got into it, and I just said, listen, I'm meeting with small business owners all the time that have supply-demand issues, that cost of steel is going up, cost of lumber is going up. Like, when's this inflation going to go down? The Fed keeps talking transitory. When's it going to go down? And we had another money manager, to their credit, thought that it would last longer. Well, what we're seeing is that inflation is going to be here a little bit longer. I'm going to show you where it was in the 70s in a minute here and where it is today. It's not there. But anyway, inflation's here. It's not here forever. It will be lower at the end of the year. But this is where we were at back in the 80s, 70s and 80s, if you guys remember that, obviously with the inflation. This is where we're currently at. The average, the 50-year average is 3.9. We were at 6.9, 7.1. Our economists feel it's going to be in the 5s by the end of the year. So inflation will start to come back down more towards its mean. But it obviously, here's a little bit longer what the Fed said. And we'll talk about that in another slide too. So you can see the average is 3.9, we're at 7. So when you go to the store and things cost more, they do. I heard, if I can recall this, on the way out here actually, one of the senators, they had the Fed meeting today on Capitol Hill. And he said, the good thing about inflation is that the value of your house or the value of your neighborhood goes up and you don't have to move. So maybe not a good thing. So Fed and interest rates, this will show you kind of where they expect things to go, the market. So you saw Powell yesterday say that this Russia thing's too new and probably a raise in March, and we expect that to happen. We think there could be 3 to 4 increases. What's interesting is the 30-year mortgage, if someone's going to take it out, went up over 4%, and now it's back down under 4%. So the 10-year bond is what that's based on. It's already built in that there's going to be a 25% raise this year into the market. But you can take a look at where they think that we're going. And in the long run, they think that the unemployment rate is around 4%, and we'll show that in a second. And then the GDP in the long run about 1.8, but we've been running really hot. So 5.5 in 2021 and 4.0 in 2022 is what they're expecting as far as the growth of the economy. So we do expect interest rates to be coming up. Higher rates, usually bullish for stocks. So I've also heard this in the last couple of weeks. If the Fed's going to raise interest rates, then it's going to hurt my portfolio, because that means the markets, they aren't doing as well, and it's going to slow down the markets when we raise interest rates. And so what this does, this goes back to 1962, and it takes a look at how long did it last, what happened to the 10-year Treasury. That's what everything is based upon, your mortgage rates and things like that. And then what's the S&P, a gain or a loss? And if you come down here to the average since 1962, the average duration of Fed, or of them raising interest rates and the Treasury going up, is 25 months. The average change is 2.9%. That's the increase in the Treasury. And the average gain in the market is 17%. So this as well points to, just because the Fed's going to raise interest rates, that we're not looking at a bad stock market ahead of us. Maybe some volatility, which we'll talk about in a second as well. But rising interest rates, especially not in a recession, does not mean negative rates of return in your stock portfolio. So I threw this in here. I'm not here to debate COVID. I'm not a doctor or anything like that, but I thought this was an interesting slide, so I wanted to put it in here. So what this is taking a look at as of October 31st, and maybe you've seen something like this, but this is showing fully vaccinated and prior infections. So it's talking about herd immunity. And if you look at the green line, if you look at the United States, we have almost looks like 60% that are vaccinated and then prior infected. And you can see it's just over 90%. When you come down here to Minnesota, you can see that at Minnesota we have about, call it 65%. And then you've got the prior infected, but we're almost to 100%. And again, I'm not here to debate how long COVID's going to be around or variants or anything like that, but I thought it's interesting to take a look at what that herd immunity looked like, and I wanted to put it into the presentation just so you could see it. I just hadn't seen this before. We see the fully vaccinated all the time, but not the people with prior infections. So I think that's a really good thing. Unemployment and wages. So take a look at the unemployment rate. Look what happened in April when we shut the economy down. Went to 14% unemployment. Guys, the average unemployment that we've had is 6.3% the last 5 years, or 50 years, I'm sorry. So the last 50 years, 6.3% unemployment, wage growth of 4%. So here's what we're seeing happen. So you can look at wages down here at the bottom. In October of 2021, we're at 4.6% wage growth. We've seen nice wage growth over the average, and now we've seen unemployment drop all the way down here to below 6%. And so with that going on, it really means we don't have any unemployment at this point. People are starting to make more. That also adds to some inflation as well, because we're paying people more to work. But that also points to a really healthy society that we have, and people that have money in their bank accounts and people that are fully employed. So obviously when you're right here, you go back to that beginning slide, it's different this time. It feels that way, right? With the pandemic and things, we've never lived through one. But the market was up 26% in spite of it. So interesting statistics. We go back here to 2009, we were down 10% in 2009. That was more sustained unemployment than this was. You can see this big up and then the big down as well. Value of investment and discipline. So this is just taking a look at this going from 50 to 70. These are averages over 20 years, but for the last 70 years, this is looking at rolling returns. So as high as 47, as low as 39. If you're all stocks, it's blue. If you're purple, it's bonds. And light blue is a 50-50 portfolio, 50 stocks and 50 bonds. What's interesting about this slide to me is as you go out on a 5-year rolling period, every 5 years for 70 years, The worst case is down 3% in stocks, down 2% in bonds, and positive if you're 50 stocks and 50 bonds in a 5-year rolling period for the last 70 years through recessions and everything else that's gone on. 10-year basis, it's -1, up 1, and +2 in a 20-year basis. So if you look at a growth of $100,000 over the last 20 years, grow to 854 is up 11.3% if you're all in the S&P 500. It's up 6% almost in bonds, and it was up 9% if you had a combination of the two. Now, are we going to do 11% this year? I can't say that. It's been the average. I can't say it. And then the same thing with bonds. I think it's going to be really difficult to get that kind of bond rate of return in this environment that we're in right now. But what I want to show you is that if you have a blend and you have 5-year rolling periods, it's a positive number to last 70 years. If you've been here before, you've seen this chart. I really like this chart. We show it to a lot of our clients when you've been in the office. And what this is showing is the intra-year declines in the market. This is going back over the last 42 years. And it's showing that the returns in the market were up 32 of the 42 years. But look at this number. The inter-year drops is 14%. We average a 14% decline every single year in the market. Last year, 5%. We were up 27, we told you that. The only thing we had was a 5% pullback last year. So why does it feel different this time? We didn't have any volatility last year. We had a great market, markets were up, and now we have volatility. We have Ukraine and Russia. We've got inflation fears. We've got all this stuff going on, all this noise. And then we couple it with no volatility. This year we've had a 10% decline this year, which is constituted as a correction. We've had it this year. But we haven't been down 14% yet. And we've got some things that are good, that are going forward. But just take a look at these red dots and what we've seen. And again, 32 of the last 42 years have been positive, and the average decline's 14%. Those are time to buy. Obviously, there's dips in the market and time to purchase. This slide's been shown as well, and this goes back to it's different this time as well. We've been receiving calls from some clients saying, hey, that are concerned, maybe rightfully so, and saying, should we sell? Should we make some changes? Should we do something different with the portfolio? And all I want to point out is this is the last 20 years in the market and what the rates of returns were. So the top performing asset classes was REITs, real estate investment trusts, and then emerging market equity, small cap. So stocks did 7.5%. A 60-40, which is 60% stocks and 40% bonds, did 6.4. But look at this, guys. The average investor did 2.9%. So the market's doing, in a blended portfolio, 6. Stocks are doing 7, and average investors doing 2.9 based upon their research. And the reason for that is they're making changes when they shouldn't. It's that phone call I received from Trudy yesterday about, I'm scared about this thing in Russia. And that somehow equates to your investment portfolio that you're going to live off for the next 30 years. People don't make good decisions with their money when left on their own. And I always tell our team that we get paid when the markets are not good. It's easy to look good when everything's going up. Last year was easy to look good. It's when we're getting these choppy markets that are volatile that you need to be able to have some conversations or some context with some things that we're showing you today to be able to take a look at. This is called a Callan chart. If you remember back in the day, what's the periodic table or something like that, right? That you were back in science class. So this Callan chart's very busy, but what I want to point you to is the black line here that's going up and down. That's if you had a blended return, if you took money and put it in those different buckets and had it diversified. And you can see it's never the highest performer, which is up on top, and it's never the lowest performer. And the asset allocation over the last 20 years did 5.7. Top performing is large cap stocks, small cap stocks, real estate investment, high yield bonds, and you can go on down the line. This chart is just pointing out that you need to have a diversified portfolio. A lot of times in our office we'll talk to you about, we call them I buckets, but we'll talk about goal-based investing, about having your money set aside in the right bucket for the right time. And if you're going to be traveling in 3 months from now, it shouldn't be with us in the market. And if it's for your 50th wedding anniversary 10 years from now, it should be. But it might not be as aggressive as the bucket you're going to take money from 2 years from now to buy your car. We need to think in proportion with our money based upon the risk and when we want it on where we invest those funds. And so being diversified is important, but you also have to have it in the right account. You don't want to be selling today when the market's down 10 to get your $2,000 of income and just be selling stocks down 10%. You want to be diversified or have a separate bucket that it's in or whatever that is. And we call it an investment management system, and we help our clients work through that. But just keep in mind that asset allocation does work. It sounds like it's cliche, kind of like just timing in investments, it's just time in. But again, it's not different this time, and being diversified is important. Again, because I like colors and can understand colors, I bring this chart to you. But this is taking a look at different areas, different countries. So manufacturing, but you can see Japan and UK and Euro. What I want to point your attention to is 2020. Look at the red that's there. So when it comes to manufacturing, we had some issues going on when we shut the economy down in 2020. But look at where we're at now and look at the green. We have red right here in Japan. China is yellow. And Russia's yellow, which I'm assuming is red now after the sanctions just went on them. But we're pretty healthy when you take a look at manufacturing globally. And we'll talk about global investments right now. Cycles of equity performance. So equities are stocks, different cycles. So you might have large cap outperform small cap, but you would have maybe Europe outperform United States. And so this is looking at different periods, and the purple bars are showing you what it was if you were in the IFA index or international index. And if you're in domestic index, what does that look like? And you can see here this, you can see the growth that you've had here. The last 14 years, United States has outperformed Europe. My question is, if I gave a kindergartner a crayon and said, color in what's next, what color would it be? Would they continue that on, or would they put some purple in there? We believe in being diversified. One of our strategic partners that we use is overweighting some international portfolios now, just like they're overweighting value stocks, which have been outperforming growth stocks. So interesting chart looking back to the 1970s, different periods where they've outperformed, but we've been on a long bull market compared to the rest of the world when you look at that chart. Consumer finances, this is where our money's invested and where the assets are. So 25% in our homes. We've got deposits, we've got pension funds, so you got TRAs and government pension funds and things like that. 42% in other financial assets. What I want to show you is this. This is what we looked at earlier, household net worth. In 2007, it was 70. Right now, it's 150,000. We've doubled our net worth, our household net worth that we've had in this country since 2007. And then household debt to service ratio, look what we've did here. So in 2007, we had 13% debt, and look at where we're now. So we've been paying down our debt and increasing our net worth in this country, which again bodes to being able to go out and spend those funds or invest them for the future. So economic activity, just today I saw the hotels and leisure, as far as their hiring is concerned, was way up in January. When you look at what's going on here, the reason I put this slide in here is look at what happened here. So consumer debit and credit transaction were down 34% at their bottom. This is the last recession we had because of COVID. Look at seated diners, down 100%. Obviously, we shut down the economy. TSA traveler traffic, so airplanes, down 96. And then now take a look at what they are. Minus 27 on TSA, seated diners only down 16, hotel only down 16, and we're actually up on debit and credit. Like I said, we celebrated our 25th. The Delta flight down to St. Lucia and back were completely full. The resort we were at was 85% full. So things are getting back to normal. Whether we want to believe it or not, they are. People are starting to travel, move around. We just use more gasoline than we did prior to the pandemic last month. So we're starting to use more gas. People are starting to move. We'll see what happens if we get to $4 or $5 gasoline, how much we're going to drive. But anyway, things are getting back to normal, guys, when it comes to the economy. So with that, I want to open it up to some questions. You guys, nobody's like waving at me as I went through this, so maybe y'all fell asleep or something. But do you have some questions on that? Yeah.
Presentation, is that going to be available?
Yeah, we can make it available. We can certainly share it with you. It's also Facebook Live, and it'll be played back there too. Yep. Yep. You want to make a note of that, Matt? And we can do it. Thank you. What else? Anything surprise you? Dan?
What do you think of the supply chain issues? How do you foresee that? And what are your experts saying about that?
Yeah, I'll go to the experts because I don't know any better than you do. It seems like it's starting to get itself worked out, and then you had blips like in Canada when the bridge was shut down, and you got blips with automaker parts in Russia and things like that. But it seems like the businesses that I'm dealing with, seems like things are getting better. Their lead times are getting a little better, but it's still going to take a while, and I don't know when that equals out. The people that we talk to are saying 2023, and they're saying first to second quarter. So, yeah. That was a question on when supply chains are going to get back up. What else? Any other questions?
You talked about the S&P was way up 20-some%.
Mm-hmm.
Forecasting 10% this year.
Mm-hmm.
How often have they negatively missed it? It actually forecasted, but it underperformed.
Yeah, I don't have that stat. I don't have that. But even last year, when you look at the chart, there were some that expected it to go backwards last year, and it was up 26%. So, yeah, it's, I always say the economists that are talking on TV, if they really knew everything, they wouldn't have to be on TV. They would just invest their own money and have it figured out. So that's why our consensus is just try to grab as many people that we trust and put them in a box and see where it comes out. But it all comes back to obviously being diversified, having the money invested in the right buckets and when you need it, that kind of thing. Yeah. Other questions? All right. Well, thank you guys for coming. I appreciate it. And if you have other questions, we're here to answer those for you and take care of things, and we appreciate the time you spent with us today. So thank you.